I like how Alex was like, we're going to show you all the good things that are happening this year, and then I'm talking about the state of fintech funding. It's not not exactly a rosy topic. So I was thinking about, it's the keynote, it's the state of, so I was thinking about the State of the Union, and the president always starts out by saying, the State of the Union is strong. And so I thought I'd start out by saying, the state of fintech funding is weird. It's really weird right now. The last few years have been pretty crazy. I'm thinking back to March 2020, 2.5 years ago, a time before COVID, time before a lot of stuff. We were raising Fund 1 for BTV, just getting it off the ground. We thought we'd do a close on March 30th, 2020. Turned out that pretty much everyone pulled their capital out of our fund, and we were like, I guess we're just gonna have like a Sheel and Jake family office fund, which would be much, much smaller than we were planning for. And we actually sent a letter out to our LPs that had committed in April, and we said, we're gonna buckle up and valuations are gonna come down really significantly. There's gonna be a lot less capital available to folks. And so it's a great time to start a fund. We have less money, but that's okay. And we were completely fucking wrong, right? Like, what happened next? Stimulus, the Fed printing money, the money printing machine going burr, as we all know. And we ended up a few months later increasing the size of our fund and ended up being oversubscribed, which we didn't expect. And what happened was all eyes were on fintech. We were like, suddenly from, I've been in fintech for about a dozen years. No one gave a shit about us for a very long time. And then all of a sudden, the last few years, we were the belle of the ball. Like everybody was investing in fintech. Everybody was changing their Twitter profile to say fintech investor. And that was really cool. That was really fun. We had a lot of newcomers in early stage venture investing. We had a bunch of new funds. It felt like anyone who had done anything in fintech could raise a fund easily. When I started my first fund in 2017, it took me 18 months. I had to beg people. And it's felt like in 2020 or 2021, literally anyone was able to raise a $20 million fund. And on the other side of the coin, we had all the PJ guys, if you know what I mean, the private jet guys, the guys who run hedge funds. They felt like they were missing out on private investments. It was like a great opportunity for them. This is where all the action was. So your Tiger, Coatue, D1s, and then like 100 other firms that don't have websites all decided to invest in fintech too. And after being public markets investors, they felt like there was an opportunity in privates. There was just like a ton of capital flowing in. So it led to a crazy year of funding. There was $142 billion funded in fintech companies alone in 2021. And the previous year, it was 49 billion. And if you go back just a few years earlier, it was about a third of that. Last year, we had 160 new unicorns. Again, up from 28 in 2020. Totally a nuts year. We had fintech SPACs. We had companies going public. It literally felt like everything we invested in was gold. And like you could find an exit, somebody would invest at a higher price. In our own portfolio, all the companies that we'd seeded that went out to raise a Series A in the second half of 2021 raised at greater than $100 million valuation. And some of these are pre-revenue businesses. It's completely insane now that I'm thinking about it at this moment. So those low interest rates and the money printer were really, really good for our business, or so it seemed. The outcome of those things was, as unfortunately we now know, a tough inflationary environment and the Fed having to hike rates 5 times this year. They've hiked it more than they have in the past 30 years. So it's been a particularly rough environment. And today, fintech companies are down 72%. Public fintech companies are down on the year about 72%. And last year, high-growing fintech companies were at a crazy, this is on the public market side, were at a crazy 25x revenue multiple. And today, that multiple is down to about 4.5x. So things have changed very drastically, very quickly. So there are about 59 public fintech companies out there. And how many of them do you guys think are in the green this year? Anyone? 11? It's actually 1. And until last week, that company was in the red. The company's Build Trust, they're getting acquired by EQT. But otherwise, the other 58 companies are all in the red by an average of 72%. It's been a rough year. So what does all that have to do with early stage fintech? Well, as the public market started falling at the beginning of this year, so did late stage valuations. We saw it in our portfolio in like kind of January, February. We had a company going out for a Series D. They had doubled revenue. We thought it'd be a slam dunk. And instead, they fell flat on their face. And we ended up doing an inside round at the same price as the previous round, even though they had more than doubled revenue. And at first I thought, that's rough. In hindsight, that flat round was like amazing. And I should have congratulated the founder. So a lot of companies raised money at a great time. Like it was easy time to raise money last year. And so because of that, the growth stage companies that are raising this year haven't been looked at so favorably. And so that's led to a drastic decrease in the amount of money that these growth stage funds are putting out. I had lunch with a growth stage VC a couple days ago. He told me they're down 90% in allocations this year versus last year. So that's a huge amount of capital out of the system. And the other thing we're seeing is the types of companies that get funded. As interest rates rose, so did the discount rate. And in consumer fintech, you had a lot of companies that were basically grow at all expenses, 3-year plus payback periods. Even some of the darling fintech companies were like 2-year payback periods. I think now we're seeing a return to the like, you gotta be sub 12-month payback period. And I think that's probably a good thing. We also saw in fintech in particular last year, every consumer business getting funded. We would always joke that someday a neobank for pets would get funded. And then I saw it. There was a neobank for pet owners that got funded. And it literally felt like every consumer business, you slap a mobile app on it and it would get funded. Unfortunately, as a lot of you guys know, customer acquisition just got really tough. Both increased competition, BaaS providers making it really easy to get a neobank set up. So things just got really competitive. And then you tack that on to the Apple and Facebook changes, and it became a really difficult a time for customer acquisition. And as interest rates rose, we decided, hey, like a lot of these companies are going to be really tough to fund going forward. And I think you're starting to see the domino effect of that interest rate rise today. And some of these companies aren't raising that next round of funding. So then you say, okay, well, what is getting funding? Surely infrastructure is okay, right? Like we love fintech infrastructure. Well, unfortunately, these infrastructure players need to sell to someone. And if that someone is a consumer player, those companies are getting less funding, so there's less growth that's available to the infrastructure players as well. But I do think that there are opportunities in fintech, even though the repercussions go far and wide. And we've seen companies in our portfolio that had a tremendous revenue growth due to the interest rate hikes. We have companies that are storing a lot of capital on behalf of their customers. we had one company actually triple the revenue with the interest rate hikes. So there are some bright spots. And although the funding challenges started with late stage, they actually did come down to Series A as well. As I mentioned, in 2021, our companies were raising crazy $100 million plus prices. This year, they've raised at much more modest prices. I'd say like 30 to 60, 70 has been what I've seen. So it's probably really just more of a return to sanity, something more akin to what we saw in 2019. Now, the one area where we've seen the least amount of change is seed funding. So somehow seed funding has stayed relatively consistent. Maybe we're down 20%, but that's a far cry from every other stage down 50% or more. And I think there's a few reasons for it. One is, as I mentioned, there's a lot more capital in fintech. A lot of new funds. Some new funds I feel like are relatively price undisciplined. They have only seen an up market and are pricing things like an up market, but when you do the fund return math, it just does not work. And then we see later stage funds. So we were recently looking at a seed deal, and it was a $3 million round, and it ended up getting done by a $12 billion fund. And you're like, why the hell is a $12 billion fund leading a $3 million round? And the answer is like, they're not doing any growth rounds, but they still want to be active. So they're investing at every stage, and they're a lot less price sensitive than other funds. So seed pricing has held up more than I would have expected. Now the other thing is, even though valuations are down, round sizes are down, it still costs a lot of money to rent an apartment in San Francisco. And so it also costs a lot of money to hire an engineer, and that inflation has impacted everyone. So the price of hiring folks has stayed consistent. So you still need a certain amount of money to get your company off the ground, and that's what we're seeing. So what does the future look like? Well, I actually have no idea. I can tell you what today looks like. Today, I'd say like in terms of pricing, we're seeing pre-seed rounds kind of return to the 2019 era. So I'll say, for us, we've done pre-seeds in the 5 to 10 range, seeds in the 10 to 20 or maybe a little bit higher for outstanding founders range. We're seeing Series A's in the 30 to $70 million range. We're seeing Series B's in the $100 to $150 million range. So, things are down pretty significantly from where they were a year ago. I do think, though, there will continue to be lots of capital available for great ideas and founders. But I do think, unfortunately, we're no longer the belle at the ball. Like people who changed their Twitter profile to fintech investor 2 years ago, then they changed it to Web3 investor, and today they're just venture investor. So I think a little bit of the sheen has come off as we've seen, the public markets fall in fintech. We've seen it across the board. So I don't think we're going to get back to the multiples of 2021 anytime soon, which is very unfortunate for all of our portfolios. But I do think that there will be less competition out there, and there are lots of great folks in the market. So I think it's a great time, maybe as great a time as ever, to buckle up and build a great sustainable business. And if you're doing that, I'd love to fund you. So please talk to me. That's it.